On today's show, we're going to talk about what you need to know when you secure a mortgage, and we're going to talk about the 3 C's. On today's show, we're going to talk about what are the items that you need to be looking out for when you secure a mortgage, and what are the 3 C's of mortgage lending. The 3 C's in mortgage lending are cash, credit, and collateral. Cash is your down payment. Where's the money coming from? Credit is what scores do you have and how have you paid your bills. If you have a collection on your credit report from a apartment complex in the last 90 days, you're probably not going to get a loan, right? We have to look at your credit. Then we're going to look at the collateral. So once you actually go and find a property, we're going to do an appraisal, and that appraisal is going to be representative of what the condition of the property is and what the value is. So that's the collateral. Those are the 3 things that mortgage lenders look at: cash, credit, and collateral. What is LPMI? Let's talk about mortgage insurance when you're dealing with a loan. LPMI is what we have. What is that? That is lender paid mortgage insurance. Lender paid means let the lender pay for your mortgage insurance. How do you do that? How do you shift the risk over to those guys? Well, you pay them a one-time fee up front, which equates to about 2.5 year break even. So you're pretty much prepaying 2.5 years of mortgage insurance premiums that you would have otherwise paid. If you pay those up front, you don't have any PMI on your loan forever. It's a great deal, and it's tax deductible because it's considered prepaid interest. It's points. So that's a great program to reduce your payment, and you get a tax write-off on that cost altogether. So that's PMI, or lender paid mortgage insurance, because if you keep that, and that may be the difference between you actually getting that dream house and not, because it lowers your payments so much that your debt to income ratio may work with a more expensive home. That's pretty fantastic. Then you have to figure out, am I going to do a 30-year fixed or a 15-year fixed, or am I going to do an ARM? Because you have adjustable rate mortgages that have a little bit lower interest rates than your fixed. Well, you have to figure out what your time frame is on how long you're going to be in the house. So we'll work with you on that to try to figure out the best strategy for you to be able to get the job done and not get you in a position where maybe the rates move on you 7 years from now or 10 years from now. My recommendation most times is just take a 30-year fix. The rates are so low, and pay extra principal payments on it, because you know if you make 1 extra principal payment per year, you knock it down to 23.5 years. That's 6.5 years reduction in payments just by doing that. As you've heard of the bi-weekly mortgage, that's basically what that is. You just do it on your own. So there's no trick to that other than the fact that you can do it and make 1 extra principal payment. You probably never miss that money. Or break it up, even make it easier and break it up into 12 extra little small bites on an annual basis, right? And you can do the same thing. So there's a lot of strategies that we can help you with to show you how you can pay that off a lot quicker. So let's talk about down payment. So that's the cash portion of the 3 C's. So that money just can't come out of the blue on closing day. That money has to be sourced and seasoned. Source meaning where did it come from and whose bank account is it in and how long has it been in there. That's the seasoning part of it. And why do we have to do that? Because federal law mandates that we find out where the down payment money is coming from, because people actually launder money through real estate transactions, because these are sizable transactions and they can do this very efficiently if they're not held accountable to where did the money come from. So the source and seasoning is 60 days. That's the key. It has to be in there for 2 months, 2 cycles on your bank statements, and then we can use those funds. Now a paycheck doesn't have to be in there 60 days. Gift funds don't have to be in there 60 days. Just money that's unaccounted for, right? That you have cash in a mattress that you've been saving, somebody gave you money, you have a business, you just didn't put it in the bank. That's the kind of money that you need to be concerned about if you're going to use it to put into this transaction. So how long have you been at your current employer? 2 weeks, 2 months, 6 years? We need to look at the last 2 years. So when you're doing a mortgage, we're going to look at the last 24 months of history. Now you may have been in school and college and just got out of college, got your first job. That's fine. We just have to account for that last 24 months and find out where you've been and make sure that we can account for those last 2 years. Again, the same thing with your income, because we're looking at, have you been employed? Are you being paid a commission? Are you being paid hourly, salary? Those are things that we deal with and make sure that you're mortgage ready in that regard, okay? Let's talk about tax returns. Have you filed your last 2 years of tax returns? Well, I hope you have, because we're going to verify those if you're trying to get a loan, right? So let's say you haven't filed your tax returns in the last couple of years, you're employed, you get a W-2, We have people that actually come in and do that. Well, we can do what's called a W-2 transcript only, where we don't require tax returns. And we just review the W-2s, we review the transcripts from the IRS that your employer submitted, and we just show what money that you've made the last 2 years. So we can do that and get a loan done without having to provide tax returns. So most lenders don't have that, we have that ability. Again, we're always looking for ways to get a loan done within the parameters of the rules of the lenders. And the last two things we want to talk about are student loans and federal tax liens and civil judgments. Student loans, 1% of the balance needs to be accounted for on a monthly basis. Give you an example. If we have a $5,000 balance on a student loan, that's $50. 1% is $50. They're going to count a payment against you of $50 for that student loan against your debt to income ratio, okay? There's a better way of doing that. If the payment's only 20 and you know that, we can get a letter from your lender stating that fact, and we can use that instead of the 1%. 1% is the worst case scenario. Say you have a federal tax lien. Well, my gosh, that's the kiss of death when you're trying to get a loan, because that takes superior lien position over a mortgage on a house. So we can't, you have to either, and we can take that, the lenders will take it if you've made 3 payments on a payment plan. If you have a federal tax lien and you have a payment plan set up and you've made 3 payments consecutively, they'll allow that, and we'll just include that payment in your debt ratio analysis. Last thing is civil judgments. You cannot have a civil judgment on your credit report because that does take superior lien position over a mortgage. You have to get that paid off. That's the biggest thing that needs to be addressed. And you need to know that, because some people, we've had them come in and they don't even know there's a judgment on their credit report. So we need to know about that. You need to know about it. And if you have time prior to buying something, say 6 months out, 6 months is not too early to go look at your credit. Have somebody look at it and analyze it. So I know we talked about a lot of different things that probably seem like mush in your mind right now. There are so many different items to deal with when you're dealing with a mortgage, but that's our job, is to make it simple for you. We figure out your situation, we diagnose it. We're specialists, not generalists, so we do only loans on a daily basis, and we will help you get through the loan process and get you into the home of your dreams. And just give us a chance at Just Mortgages. If you like this video and you're looking to buy your first or next home, give us a call or visit our website.